Two stocks I'm buying in July of 2024. This is a video that I don't do very often. I've only done it twice so far in 2024. I'm going to talk about two stocks, very interesting stuff. One of them I've discussed before. The second one I've never talked about it, never ever. And I believe it's presenting an amazing opportunity in a critical sector, very hated sector. And I'm confident you're going to enjoy this video. All I'm asking from you, if you could please press the like button if you do enjoy it and let me know what you think in the comments. But I did do a video to explain my strategy. It's called Revealing My Most Profitable Strategy, Deep Value. And it mainly explain my strategy was to look for hated sectors, hated industries, hated stocks, stocks that just fell out of love. And it does happen every single year. Sometime, for example, in 2022, people were excited about energy stocks and oil stocks. They weren't too excited about tech stocks, Magnificent Seven stocks, which are now the Magnificent Seven, and many others. And this is when, for example, I jumped in, and this is a screenshot of me buying Google. I bought Google at $84. It was right at 52-week low. You could see a stop over here. This is like a strategy I use to buy stocks in a bear market, you could say. But I did buy Google at 52-week lows when people weren't buying Google. Now everyone is buying Google, so I'm buying something else. Like, for example, I shared Bird Construction. It's up 85% year to date in a sector that no one even discusses. And I talked about it in this one. It says the best investment opportunity no one's talking about. And this is what I'm going to discuss. This is my strategy. And those two stocks fit this strategy perfectly. I don't like to keep mentioning this, but maybe for new investors, so far this year, if you look at my screenshot, I'm up 41%. Here it shows 35%. That was as of June 2nd. I shared 3 examples. I shared every single year, everything I did on YouTube. 2023, I was up 28%. 2022, I was up 27%, buying stocks and shorting the S&P and stocks outside the indexes. But this is what I do. I look for hated stocks when people don't love them. When I do love them, I get out and I move on. Okay. Now for the stock or for the industry, it's an industry, it's called natural gas. I'm sure you're going to skip because you're going to say it's boring. But I showed you many boring stocks that have outperformed many of the shiny stocks that you might have heard of. If a company is boring or an industry is boring, it doesn't mean you cannot make any money in it. And that's my favorite ones. Because again, when people focus on the AI stuff, they ignore other stuff. Natural gas was something that was loved in 2022. It was rallying along with crude oil. People were bidding up the stocks, people getting exposure in funds, and energy was like the best thing ever. And energy analysts outperformed every single stock picker in the S&P and stuff. But now you don't hear about it very much, right? You don't see people going on television, CNBC, or even on YouTube telling you, I'm bullish on energy stocks, I'm bullish on natural gas, I'm bullish on ExxonMobil. You don't hear that very often. But especially natural gas. Natural gas, if you look at this chart, it hit a generational bottom. They only hit it a few times in 1999, in 2016, in COVID, and we hit it again like it was in, I believe, 2024, March of 2024, like a few months ago, and we bounced from it. And I highly doubt we're ever going to get back to this level. So LNG over here, or I should say natural gas in general, is at a very interesting level, very interesting point. And my stock, my LNG stock, which I'm not supposed to talk about because it's a new one, I bought it recently. I'm planning to buy more, and some group members are gonna be mad. But I mean, I try my best. I ran out of ideas. I have to talk about it, and it's actually called LNG. So I'm investing in LNG, and the stock is called LNG, which the name is Cheniere Energy. I believe this is how you pronounce it. It's only up 1.6% year to date. My cost basis is $166.50. Now it's at 172, so I'm up slightly, and I'm planning to buy more. Over the last 5 years, the stock has been pretty much flat since late 2022. It has been consolidating, and we recently had a breakout. And I believe, again, the stock is at a very interesting point in terms of technicals. But Cheniere Energy owns 2 liquefaction facilities in the United States, the largest one in the United States and the second largest in the world. They own, or they actually work with many different counterparties like, Royal Dutch Shell, Chevron, and many PetroChina and many different things. And it's all over the world. So they do ship the liquefied natural gas all over the world, but their markets are mainly Europe, Asia, Latin America. But again, they ship all over the world, but it's recently been mostly in Europe. So it goes all over. This is critical for energy security and for the future. Now, if you look at this first quarter, it wasn't the best. If you look at distributable cash flow, which is the most important metric with this company. They have a lot of expenses they have to adjust for. But if you look at distributable cash flow, which is a cash flow available to do buybacks and dividends or to pay down the debt, it went from 2.9 billion to 1.1 billion. And this is, of course, normal because the company had some obligations on much higher natural gas before, and natural gas fell a lot. And again, of course, distributable cash flow is going to decrease. And that's what happened. But something has changed since then. The company is operating a new model. And the model is, this is how I got it from the investor relations page. I actually messaged them and they replied to me on my email. And they told me that now they have 17 years worth of fixed fee contracts. The fixed fee contract is 2.5, and then I get something called a 5% lifting margin. So if it's above 2.5, they get an extra margin. So they do benefit on the upside. Every $1 of natural gas above 2, they get around 300 million extra to distributable cash flow. But they have visibility and obligations of over 17 years. At around a fixed fee of 2.5, it's gonna still be volatile, not as much as it was before. It's gonna be volatile on the way up and on the way down, but it's gonna be largely stable, and it's gonna provide them visibility for the free cash flow. Now, at 2.5, now it's at 2.6. Now, it might go a little bit higher, then they can make another 300 million. It's like if it stays at 3 on natural gas, they're gonna make another $300 million on the distributable cash flow for the year. So it's pretty amazing stuff. And it's, again, natural gas itself is at a very interesting point. But the main thing with Cheniere Energy is that they have the 17 years contract. And if you look at it, this is what he told me. He told me, because of this contract structure, we view Cheniere as a long-term contracted infrastructure story with minimal commodity exposure. So the free cash flow is visible. And this is, in my opinion, the best way to bet on natural gas while having some downside protection in case natural gas was too volatile. You're going to benefit on the upside, but you're not going to have a lot on the downside. Now, for distributable cash flow, it's expected to be between 2.9 to 3.4. And this is expected with all the natural gas, of course. So it's between 2 on natural gas to 2.5. 2.5 would be 3.4, 2 would be 2.9. It's been recently holding above 2.5. It's around 2.6 right now. But if we take, for example, 3.2 billion on average, take 3.2 billion in distributable cash flow for 2024, the company right now is trading at a $39 billion market cap. We take an average of 3.2 billion. This is around an 8.5% free cash flow yield. So the company is actually trading at an 8.5% free cash flow yield with 17 years worth of contracts at a fixed fee. This is dirt cheap for this company. But it gets even better because the company is also expanding. They have a lot of expenditures that they are trying to complete. This is stage 3 for one of their facilities. Stage 3 will likely be completed between the first half of 2025 to the second half of 2026. I think it will most likely be late 2025. Then they have 2 more projects, and those 2 projects, they do require approval. They did get approval on the first one, not on the second 2. So this would benefit a lot as a catalyst. If we have a change in administration, they have an easier time getting approved for those contracts. That's going to make it's going to be a catalyst for the stock. That's going to cause the stock to shoot much, much higher. But if that doesn't happen, the stock is still undervalued at an 8.5% free cash flow yield that it's expected to increase. Okay, now this is the key. I did show you 3.2 billion of distributable cash flow, but this cash flow is expected to increase. If they complete stage 3, which I told you is going to likely be completed by late 2025, if they do complete it, the distributable cash flow jumps between 3.2 billion to 3.5 billion on the high end. 3.5 billion on the high end is like a 9 or 9.5% free cash flow yield. Again, counting between 2 to 2.5 on natural gas. If they complete all the projects, which they expect to complete by 2027, then the distributable cash flow could go as high as $4.3 billion by 2027, which is, I believe, around an 11 or 12% free cash flow yield on this company. So there's a lot of upside for the free cash flow, not just from natural gas prices, but also from the expansion stages which they are about to complete. Now, there's something even better. And this is the company's goal. And they have a goal which is called 2020, which is to deploy $20 billion and to get to $20 per share of distributable cash flow by 2027. They're going to get there by, of course, completing stage 3 and completing the other 2 projects. If they can complete them, and they said on the call they are ahead of schedule, then they get the distributable cash flow would be $20 per share. Now, $20 per share times a 15 multiple, now it's trading at a 17 multiple. But we get the 20 per share and we time it by 15 multiple. This is $300 per share. We divide it by the current price of 171. This is 75% on the upside from now to late 2026. So I would say around 75% on the upside over the next 2 years. With something like Cheniere Energy, the worst case scenario is an 8.5% free cash flow yield for a company that's going to get to $20 per share by buying back a lot of stock. They already bought 10% of the market cap. They have a buyback program to buy another 15% of the market cap by 2027. It gets them to 200 million shares, and they also want to grow the dividend at a 10% annual rate, which is good for dividend investors. They are looking for a dividend growth company. So to sum it up for LNG, there's a lot of upside catalysts. If we have a change in administration, they're going to have an easier time getting the permits, getting them approval to start on the projects. If the projects are completed, free cash flow is going to be much, much higher. It could get up to $20 per share, which would mean 75% on the upside for a company that has 17 years worth of contracts at a fixed price. And you also have upside from natural gas. If you believe inflation is going to come back, natural gas is a pretty good bet, in my opinion. And it went to a generational bottom that I believe we're likely going to go much, much higher from here instead of us going lower. But anytime it's sitting above 250, all the 8.5% free cash flow yield is going to be much, much higher. It could be 9%, 10%, 11%. So you have many different upside scenarios for the company. And LNG is in a very high demand globally, mainly from data centers. This is another catalyst that all data centers, they are consuming more energies than countries like Italy and Taiwan and Spain, many and more than countries. And some of them are powered by nuclear, but some of them are also powered by natural gas. So this is another bet on AI, if you want to say it, if you want to call it a bet on AI. But there's a lot of demand for LNG. Supply is not going to come in before late 2020s, 2028, 2029. I will likely be out by then. But I personally believe I can get a 2x in 3 years on something like Cheniere Energy. And I'm getting, worst case scenario, 8.5% free cash flow yield with 17 years worth of contracts. So I really like the company. That's why I bought it. And I'm holding it for the next 2 to 3 years. But again, I might change my mind. I change my mind quickly if my thesis changes or something doesn't work out. I might sell and move on. But I'm seeing a lot of opportunities with that stuff. Many different companies in the drilling sector, onshore and offshore drilling. No one's excited about them. They're trading at 20% free cash flow yields. I share everything I do in my own group. If you're interested, this is the link. Now, the second ones that I bought, which I talked about it, I'm not going to talk about it very much. And it's a stock called Pepsi. Pepsi is sitting at $166 per share, down 10.7% over the last year. It's now trading around 20 times earnings. Around 20 times earnings. But this is when I get the comments that Pepsi should be trading at 15 times because the growth story is over, which is I always get. I mean, I bought Pepsi around, I would say 8 or 9 times. And every time I buy the stock, it's the same narrative. People start hating on it. The stock goes down, not because of Ozempic, not because it's overvalued, but because of rotation in the market. It goes down with McDonald's, it goes down with defense companies, and they just go down because people are excited about AI. But once this rotation changes, the stock goes up 10 to 15% in 2 to 3 weeks. And I sell it and I do it again. And I was clear that Pepsi to me is not a long-term investment. And that's what I do with Pepsi. I park cash in it and I put it on Twitter. I got comments, it should be trading at 15 times, it's overvalued and all these things. I mean, you cannot compare Pepsi to a company with no pricing power. You cannot compare any company to Pepsi that's just growing faster. That means Pepsi is overvalued. It's not the way you value those stocks. Now, some stocks like Costco trading at 50 times earnings, to me, that's overvalued. And I don't know why this is happening. I would much rather buy Pepsi. And Pepsi, for the companies that I'm getting amazing value at this price. And only in hindsight, people will look back and say, oh, Pepsi, at 20 times earnings was cheap and all that stuff after it plays out. But in the meantime, you have all kind of reasons not to buy because of Ozempic, because it's overvalued, because the growth is coming over, because they cannot raise prices forever. And the company has proved it wrong every single time. And I think they will do it again. And this is my thesis on Pepsi. This is my thesis on Cheniere Energy. Both of them are unloved stocks, and this is what I look for. Thank you again for watching. If you did enjoy it, press the like button, and I'll talk to you in another video.